Are you thinking about buying a home in 2021? Or maybe you've already started the home buying process and you've heard the terms pre-approval and pre-qualification, but you're not really sure what those words mean or what the difference is. Well, in this video, we're going to clear all that up. Hey, my name is Nick Paolozzi and I'm a real estate agent with RE/MAX Southern Shores here in Myrtle Beach, South Carolina. Today, we're going to be talking about the differences between getting pre-approved and pre-qualified, which one's better, and why it's important to speak with your lender before you go out and look at your first home. And be sure to stick around to the end of the video where I'm going to discuss one of the main factors in determining whether or not you'll be approved for a mortgage and for how much. A pre-qualification is an overview of your financial history based on information that you provide to your lender. Your lender will ask you for your income, your debts, your assets, and your credit score. And they'll review over all the information that you provided and give you an estimate or range on what they think you can qualify for based on the information that you provided. So in a pre-qualification, you do not need to provide any documentation. It's all based on what you tell the lender. A pre-approval is much more involved than a pre-qualification. You'll need to complete an official application and provide documentation for all of the information that you provided to the lender. So this will include bank statements, W-2s, pay stubs. The lender will verify your credit score and run a report. Basically, it's a complete verification of all of your assets, your financial obligations, and your income. Your lender will then pre-approve you up to a specific dollar amount, and you'll have a better idea of what your interest rate will be and what your payment will look like. Now, obviously, because a pre-approval is much more in depth and there are actual documents to back up all of the provided information, a pre-approval is the way that you want to go. Not only will you know exactly what you're pre-approved up to, but you'll have a better idea of what your monthly payment will look like. There are two main reasons why you want to speak with your lender before you start looking for homes. The first reason is you'll know your budget right up to that specific dollar amount. And not only the overall budget, but the monthly budget as well. I've seen many times where buyers will go out and start looking for a home because they think they can afford a certain amount. And they find a home that they absolutely fall in love with. So they go and speak with their lender. And after speaking with their lender, they realize they're actually only qualified for maybe $150,000 instead of $200,000. Well, now everything else that they go look at is just not going to meet their expectations because they fell in love with a $200,000 home that they cannot afford. On the flip side of that, you might think that you can only afford a home for $200,000. So you go out and you start looking at different options in that price range, and you don't really see anything that fits your needs. So you decide to give up because you thought you could only afford a home up to $200,000 and you covered everything in that price range and you didn't find what you were looking for. When in reality, if you spoke with your lender first, you might have realized that you were qualified for up to $250,000. So instead of getting discouraged and thinking there was nothing out there for you, you could have been searching in a price range from $200,000 to $250,000 and you could have found the home of your dreams. At the end of the day, shopping for a home involves tons of emotions. It can be difficult at times. So going out and speaking with a lender before you go out and look for a home can really help you avoid some of those ups and downs, or at least minimize them a little bit. Another reason why you want to make sure you're pre-approved before you go out and look at a home, especially in a hot market like we're in today, is because there are tons and tons of buyers out looking for the same exact home that you're looking for. And when it's a seller's market, there aren't that many homes to choose from. When there's low inventory and high buyer activity, aka seller's market, every minute counts. If you have your pre-approval letter in hand when you're looking at homes and you fall in love with a home that you see, you can go ahead and write up the offer. You don't have to wait for your lender to review over your documents and get you that letter. This way you can submit it with your offer. Because a lot of times a seller will not even look at your offer if you do not have that documentation saying that you can afford it. So to recap, the difference between a pre-qualification and a pre-approval is the verification of all of the information that you provide to your lender. That information includes your income, your debts, your assets, and your credit score. When you're pre-approved, that means all of the documentation is verified. And when you're pre-qualified, that means the lender says that based on the information you provided, you should qualify for a loan from X amount to X amount. But they can't really say for sure because they haven't looked at the information themselves. Before I sign off, I want to talk about one of the most important factors in determining whether or not you'll be approved for a mortgage and for how much. So people often know about their income requirements and their credit score requirements, but they've never really heard of the debt to income ratio. This, along with the credit score, are two of the most important things to get you qualified for your mortgage. The debt to income ratio is a percentage based on your monthly debt obligations versus your gross monthly income. This calculation and percentage determines whether or not you will qualify for a loan. So each loan program has a different maximum of what your debt to income ratio can be and will ultimately determine how much you can get a mortgage for. And that maximum percentage will vary based on your credit score. I'm not going to go into too much detail talking about the debt to income ratio and how to calculate it and really show you why it's super important. But if you'd like me to go over that in a future video, leave a comment down below and we can go over all the different calculations, how to figure out your debt to income ratio, and how to use that to determine how much you can spend monthly on your housing costs. That's going to be it for this video. If you learned something new, I'd appreciate it if you scroll down below and hit that like button and turned it blue. Not only does it help the channel out, but it lets me know that you found this information useful. While you're at it, go ahead and subscribe as well. This way you can keep up to date with everything I post in the future. If there's something you want to learn about in the future, go ahead and comment down below. This way I can cover it for you in another video. I'll catch you next time. Peace.